Hey everybody, we're back again with a special video, and we're going to talk about a dividend payout schedule. You definitely want to check this out in our starter pack that we have, as we kind of explain this a little bit, but we're actually going to go into a little bit more detail here for you for being a subscriber. So go ahead and listen up. This is going to be some great information. Basically, we're going to talk about how income investing works. So investors use what is called income investing, where they invest in stocks that have dividends. Now, when the dividends pay out, they tend to pay out every 3 months. Some stocks actually even pay out every month. But if you think about it, that means that you're going to get a steady stream of money every 3 months or every month. So therefore, it's going to be constant income, no matter if the stock is going up or if it's going down. ETFs also can pay dividends as well. Your mutual funds pay distributions. So these are all something that you can factor in. And the way that we have our board set up here is we have the months going across on top. So we have January, February, March, all the way through December. And then we have your stock, ETF, mutual fund, whatever security that you have over here going down. And so what we're going to do is we're going to go ahead and say, okay, let's say stock A pays a dividend in January, right? So we have X marks the spot. Now we're talking about every 3 months. So if we're every 3 months, we got January, February, March, then April, May, June, then July, August, September, and then October. So that means that stock A is paid out 4 times a year because it's every 3 months and there's 12 months in a year. So guaranteed January, April, July, and October, you're going to get a dividend. Now let's say this stock has a dividend of $1 annually. Well, that means that every 3 months, you're going to get 25 cents per share of stock that you have. If you have 100 shares of the stock, then that means you're going to get $25 every 3 months, no matter if the stock goes up or if it goes down. And another key is going to be is a lot of companies, they increase their dividend. A lot of income investors like to focus on companies that have been increasing their dividend every year for the past 10 to 20 years. So that's something to be mindful as well. So just because it's 25 cents every 3 months or $1 every year per share this year, next year it could be 30 cents every 3 months or $1.20 for the full year. So that's just something to be mindful of when you're doing income investing, and that kind of adds to your compound interest. So now we'll move on to stock B. So let's say that stock B pays out in February, May, August, and November. Now you already see what the pattern is going here. So we have one stock that paid out, then the very next month we had another stock that paid out a dividend. Now let's go ahead and go to C here. If you see C, let's say C pays out in March. Then we skip down to June, skip down to September, and then all the way to December. Now, just from our first 3 stocks in our portfolio, we can see that we have a dividend payout every month of the year. So if this is 25 cents a share, this is 25 cents a share, and this is 25 cents a share, and you have 100 shares in each of these companies, that means you're going to get $25 here, then $25 again the next month, then $25 again the next month, and it's going to repeat for the rest of the year. So you just made $25 a month from these 3 companies. Now if we factor in, that's 12 months and you're getting $25 a month. So 25 times 10 is going to give you $250 plus another $50. So you got $300 from dividends through income investing, no matter if the stock price goes up or it goes down. You just got $300 in essentially free money. But it doesn't stop there. So now, let's go ahead and repeat this again. Let's say stock D has the same schedule as company A. So boom, January, where we at? April, July, and October. Then stock E has the same payout as stock B. I know you're seeing what's happening. Stock F, of course, pays out with stock C. Now, before we get to G, we can see that we're getting 2 payouts every month of the year through dividend or income investing. So here you can see stock A and B, you're going to get 2 payouts. And let's say each one was 25 cents a share. You have 100 shares. So now you're at $50 for the month of January, then $50 for the month of February. So now we mentioned that that was $300 before with the first 3 stocks. Well, now you multiply that by 2. Granted, let's say everything is remaining the same in terms of dividend payout and how many shares you have in each company. So now you're looking at $600 annually in dividend investing income. That's just from the dividends. Now, mind you, the stock market on average increases 5 to 10% every year. So on top of that, your stock price, or let's just say your portfolio as a whole, is standing to gain another 5 to 10% on itself on top of the dividends that you paid out. Now we got G standing down here all alone. Let's say G is a stock that pays out every month. I know some REITs, which are real estate investment trusts, they act like a stock as well that you can invest in. Some of them pay out every month. So let's say, boom, here we got every single month of the year, G is paying you a dividend. So now we talked about, we had 2 stocks every month that were getting dividend payouts. Now we actually got 3 stocks every month. So we're talking about 3 times that. So we're looking at, granted, everything stays the same at 25 cents a share. We're just using this as an example. Nice round number. And we're talking about 3 times a year. You know, that's going to be $900. That's $900 of free money through dividend income investing. And that essentially is just how income investors do it. They find stocks. They like to make sure that they're good companies. Some of them can be growth stocks. A lot of times the growth stocks, though, don't tend to offer as high of dividends, simply because they're trying to use that money for the company for innovation, to further their process. But when you think about, well-established companies, a lot of them that are in the Dow Jones, a lot of them are going to offer higher dividends simply because they kind of don't have that much growth left to go. So this is the way dividend, and you can easily set this up in an Excel spreadsheet. All you have to do is, you can put your months on top. You can put the stocks going down in your column. Well, your months are your column, your stocks are going to be your row. And you can simply plug and chug all the stock that it is. And then what do? On the ends over here, you just write what the totals are. So you total all of them up. You can do your sum equals, and then you can do the same thing over here. You can get all your totals. And of course, this is your big total. So all of these will equal this final number, and then all of these will equal this final number. And so when you add all this up, when we talked about the 900, this is essentially what you're going to be getting paid out down here. And you can expect that every single year. And then imagine if these dividends, if their prices go up, that means that your total amount is going to go up every year. So let's say if this year you made 900, then the next year maybe you're going to get 1,000, and the next year you might get 1,200. Like, it's just going to continue to increase and increase. But of course, you want to manage your stocks in your portfolio or your securities and make sure that it's a good investment for you. So that's just, our lesson for today in terms of on income investing, using dividends to get paid out every month, regardless of how the market is doing.